CNBC Thursday, and I said this is a major impediment for stocks. This is, two things make up stock prices: earnings and interest rates. And all the good news on earnings is basically out there. I mean, this has been a super year, far better than expectation, but it's already in those prices. What is not in the prices is a sudden movement upward in the long bond. The Fed saying, again, that it's going to be very, very aggressive, another hike in December. They say 3 hikes again in 2019. This is really competition for stocks. The dividend yield of the S&P is 1.8. We're going to be almost double that if we move into the 3s. You got to get capital gains in. For years you didn't have to get the capital gains to do better. Now you got to get them. I think it's going to be impediment for the fourth quarter. At the end of last year, I said it's going to be a 0 to 10% return on S&P, and I thought, I might have been a little bit too cautious, but I'm going to stick to that in terms of what this year begins. I think fourth quarter is definitely going to be challenged.
Wow, because of these rates. It sounds like you're having a bit of a change of tune too. But we've spoken with you. We've spoken with you recently. You didn't sound all that alarmed about where the stock market was. Then we've had this bit of a jump in rates.
Right, but that was before the rates. Yeah, that was before the rates moved up. It was between 2 3/4 and 3, and it was sort of, then all of a sudden in the middle of September, it jumped up to 315, a little bit of a trouble. Then it's moved up. Now we have a strong employment report, and it's psychology. Look at all the potential negatives. We have a government deficit of $800 billion. That's pouring onto the market. The Fed is, doing negative quantitative easing, which means they're selling treasury bonds. You add those two up, that's almost $1 trillion onto the market. And what are the Chinese going to do? Are they going to continue to buy? They haven't been buying. So that means the domestic holders have to absorb $1 trillion of treasuries. And if they think the Fed is going to be aggressive on the short end, why are they going to do it at 2.8, 2.9, or 3%, or maybe even 3.25? Again, this is psychology. These are the sort of factors. Say, oh my goodness, I always thought rates should be higher, but they weren't. So hey, we can relax. And now, when rates go up, maybe the things I was worried about, maybe that's going to be a problem for the equity market and certainly the bond market by definition. And I think that sort of psychology is going to creep in to the decisions. That's going to make this quarter a difficult one. Again, not a bear market. It's just that the good news is out there. I don't see any more great news, good news, and I see potential risk.